your personal details with Forex Cube, and you'll be able to get a demo account and perhaps put some trades on as we go through the webinar tonight. So, topics we're going to cover through this evening. What is a candlestick and how to read them? 5 bullish candlestick formations, how to spot them or identify them, and how to trade them. The effectiveness of these patterns using different time frames, and at the end we'll have an open-ended Q&A session. So, before I go on, Forex and the financial industry, the financial markets, always comes with a certain level of risk. And here is a disclaimer. Obviously, I'm not going to read through the entire slide. This is just basically saying, in very short, simple terms, that you should always consider how much money you would like to invest in the Forex markets. Don't invest money that you cannot afford to lose, essentially. Okay? So, bear that in mind. I want to cover some very basic theory for all of the newbies or very new beginners to the Forex markets. Some terms that you should familiarize yourself with in order to follow this webinar and the markets in general effectively. So I've put together a very quick glossary for all of the beginners. So bearish, that's a very common word used in the markets. Essentially, it means that the sentiment of the market is to the downside and traders are looking to sell. Bullish is the opposite of bearish, and it means the market is looking positive and traders are looking to buy or are already buying. Short means selling, long means buying. Price action. Price action is the movement of an asset's price plotted over time. Price action forms the basis for all technical analysis. Many traders rely solely on price action and the formations and trends extrapolated from it to make trading decisions. Support and resistance. Bearish and bullish price levels of an asset are clearly revealed at areas of support and resistance. Asset prices can bounce from a support level and move up to a resistance level and then retreat back down. It's important for Forex traders to first identify trend direction and then choose to, in simple terms, buy at support levels and sell at resistance levels. So, what is a candlestick and how do we read them? Believe it or not, they've been used for a very long time, many centuries. In fact, they came about in Japan in the rice trade and have been carried on through the ages of commerce and transferred to modern day chart pricing. They're most commonly used, and most traders find that they are the easiest way to view and predict price action in the financial markets. So how do we read them? So we have here in this image one bearish candlestick on the left, which is the blue one, and on the right the red one, which is a bullish candlestick. Okay. There are 4 elements in a candlestick. We have the open, close, the body, and the wicks. The candlestick's body will turn blue if the close price is above the open price. The body will turn red if the close price is below the open price. The colors depend on the chart settings in MetaTrader 4 and also depending on your chart settings in MT4. Each candle can represent a different time frame. So I'm going to demonstrate this very quickly. So you can see now we have MetaTrader 4. Let's just expand one chart. Let's look for a bullish, a bearish, and a bullish candle. So just to demonstrate, if I hover my mouse over this bullish candlestick, on my settings, you can see that I like a bullish candle to have a black body and a bearish candle to have a white body. Now, it can all be customized by right-clicking on the chart and going into properties, and here you can see, obviously, you can customize it to however you like it. I find this is easier on my eyes, and when staring at charts all day long, I've over the years, this is just the colors I prefer, you know, to avoid getting migraines or headaches. So this is just my personal preference, and of course you can choose you know, what colors you prefer. So we have, if we hover over this, let's start with a bearish candlestick. Okay, this candlestick in a downward direction. So I'm going to hover my mouse over it. You can see the time that it's opened. I'm on a 15-minute chart time frame, and you can see the open was 1.2398. The high of this candlestick was 1.2400. The lowest it reached, which is represented by the lower candle, or wick, sorry, was the lowest it reached was 1.2377, and the high was represented by this upper wick, and it was 124.00. Okay, so we have the open. It opened at 123.98. The highest it reached was 124. The lowest it reached was 123.77, and it closed at 123.80. Okay, and we can just sort of flip that and turn it up on its head, and the opposite with a bullish candle here. You can see the date and time. The open was 123.79. The high was 123.86. The low was 123.72, and the close was 123.84. Okay, so those are the elements of a single candlestick, or let's say, you know, a bearish and a bullish candlestick. All right. So that's how we read them. Now, tonight we're going to focus on 5 candlestick formations or patterns. All right. We've got the inverted hammer, the bullish engulfing, the piercing line, the morning star, and lastly the 3 white soldiers. Sorry. There are many different candlestick patterns that can give traders a signal to buy or sell an asset. All the patterns that we are covering today are bullish patterns that give buy signals. All of them have variations or complete opposites, so it can be easily confused. It's important to be patient and careful when looking for signals to enter the market when using this method of technical analysis. All of the patterns vary in levels of popularity, accuracy, and effectiveness over certain time frames. The additional usage of technical indicators for secondary confirmation and the location of the candlestick patterns within an existing trend are all extremely important as well. It's not a guaranteed system. Okay, the use of candlestick patterns is not guaranteed to give you, you know, the perfect entry point or exit point for your trades. There aren't any guaranteed systems in Forex, and anyone who tells you that there is a guaranteed system that will consistently make you money is probably lying to you, so please beware of these individuals, okay? There are many factors that can throw your technical analysis off course, so bear that in mind as well. What I mean by that is things like fundamental events, news headlines, these types of things that can really move the market in a very volatile manner. Okay, so next, let's move on to the first hammer. Inverted hammer candle pattern. Okay, so what we're looking at here is just one of the hammer formations. Okay, the inverted hammer candle. There are many different types of and variations of the hammer, as you can see from the second image. We want to focus on the inverted hammer, which is the image on the left. Okay, it's a bullish reversal pattern. It signals that an asset is nearing the bottom of a downtrend and should start correcting to the upside. So how do we identify an inverted hammer candle pattern? The candle has a small body, a long upper wick, and a little or no lower wick. The extended upper wick suggests that the bulls are looking to drive prices upwards. As I just mentioned a moment ago, the additional image in this slide is just to demonstrate that one must be extremely careful not to confuse an inverted hammer with any of the other variations of the hammer. So you have a simple hammer, inverted hammer, hanging man, shooting star, and you must be careful, not to confuse these different formations. So how do we trade the inverted hammer? It involves a lot more than simply identifying the candle. The location of the inverted hammer candle, when viewed within the existing trend, is crucial for this pattern to work for you. You look for a support level in a downtrend, and you would it's ideal to use a secondary confirmation with technical indicators like relative strength index, or even Fibonacci levels or moving averages, and this will give you an added confirmation. So let's have a look if we can find an inverted hammer within MT4. So I'm going to pop back into MetaTrader 4 and let's have a look for an inverted hammer. Let's have a look at New Zealand US dollar. So where can we find? Let's move on to a daily chart time frame, okay, which I've done here. I'm going to get my cursor and look for the inverted hammer. So we can see a downtrend here. Okay. No, not quite. Ooh, okay, there we go. That looks like an inverted hammer to me. I want to zoom in a little bit to demonstrate this to you a bit better. So what was that? The 17th of June. There we go. 17th of June. So on this particular day, you can see, so we've got a very small body, little or no lower wick, and an extended upper wick, which demonstrates that there is more bullish or more sort of buying activities and more investors looking to, they can see that the downtrend here. Okay, so it's important. We've identified the inverted hammer in the downtrend. Okay, and that's the inverted hammer there. And as you can quite clearly see, it's worked exactly as it should do. We now see if you had entered or put in a buy position at this exact time, you would then have made a decent profit over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, nearly 2 weeks. There's some consolidation here where a little bit of a downtrend, nothing goes up forever, but that is the inverted hammer right there, perfectly demonstrated. Okay, at the bottom of a downtrend, and now it's moving upwards. Okay, so that would have been a very nice trade. You could put your stop loss, a stop loss here. Let's say if you were to buy right here, a stop loss would be this would be a good place to put a stop loss. Let's say just underneath the inverted hammer, and you can see it's at a support level. Okay, so it's a good place to put a stop loss, and you might want to put a take profit order, let's say at this resistance level here at the top of the beginning of the previous or existing downtrend. before the inverted hammer occurred. Okay, so let me just delete these support and resistance levels, and we will go back into the presentation. Okay, so the second pattern that we want to focus on is called the bullish engulfing candlestick formation. So the pattern is one of the financial market's most accurate price action signals. The pattern involves two candles, with the second candle completely engulfing the body of the previous candle, the initial candle. Okay, so in this case, the red candle is being completely engulfed by the green candle. Okay. So we identify this pattern by firstly identifying the bearish candle, followed by the bullish candle that completely covers or engulfs the previous red candle. There should be a gap lower down on the bullish candle, so it opens a little bit lower or at the same price, ideally a little bit lower, so that we're completely engulfing the body of the bullish candle is engulfing the body of the bearish candle or the red candle. Okay, so ideally it opens at a lower price, and it should close obviously above the previous candle's open, all right, or opening price. Now again, the bullish engulfing pattern appears at the bottom of a downtrend. Ideally, this is where you want to be spotting this pattern in order for this formation to work effectively for you. It indicates a sudden increase in buying pressure in the market. So the bulls are coming in, the market's looking more bullish, and it's a buy signal. Okay, as long as it's in the correct place in the existing downtrend. So it often triggers a reversal, as more buyers enter the market to drive the prices up. So how do we trade it? The correct way to trade the bullish engulfing pattern, it's a good confirmation to enter the trade if subsequent or following candles validate the pattern by closing above the high of the bullish candle. Okay, so a stop loss can be set below the low of the bullish engulfing pattern or candlestick, and you could set a target at a resistance level. I'll demonstrate an MT4 in a minute. Use of technical indicators, once again, relative strength index or moving averages are also a good way to gain confidence and get the best possible results using this pattern. Okay, so let's have a quick look in MetaTrader 4, see if we can spot a bullish engulfing pattern. So let's have a look at, what should we go for? Euro, New Zealand dollar. Okay, so Euro, Kiwi. Again, I'm on a daily chart time frame, so each candlestick represents 1 day or a period of 1 day. So let's have a look if we can spot a bearish engulfing pattern. Let's get the crosshair. Let's have a look. Well, there we go. Okay, I think that would count as a bullish. That definitely counts as a bullish engulfing pattern. All right, so as you can see, we have two candlesticks, a bearish candle, a bullish candle. The bullish candle is completely engulfing the body of the previous bearish candle, and there was a slight gap lower on the open of the bullish candle. So this counts as a bearish engulfing. It's at the bottom of a downtrend. Okay, so the prices have been coming down, a bit of indecision here, a little pop up, and then we have our bearish candle and a bullish candle that completely engulfs the previous bearish candle. All right, so this is the bearish engulfing, and as you can see, traders have spotted this and started buying, and there you go, another great opportunity to make money on the forex markets using the bearish engulfing pattern. Okay, so that's pretty much the bearish and the bullish engulfing pattern. Let's go back to our presentation now and move on to the next pattern, okay, which is called the piercing line. So the piercing line is also formed of two candlesticks. It points to a potential buy trade. The piercing pattern shouldn't be used in isolation, once again, but rather in conjunction with other supporting technical indicators to confirm the price change in price action. Okay. So we have a bearish candle and a bullish candle. Okay. How do we identify this pattern, with confidence? The bullish candle opens lower than the close of the bearish candle. The bullish candle then closes above the 50% level. Okay, as I'm pointing out here on the slide, it closes above the middle or the 50% level of the bearish candle. So the close is here, it's closed above the 50% level. All right. Also, again, it occurs at the bottom of a downtrend. How do we trade it? Traders will look before entering into a buy trade or a long position. It requires additional confirmation using other indicators, again RSI, moving averages, even Fibonacci's. RSI indicates oversold and overbought assets. In case you don't know, traders also like to use the moving average for this pattern. So maybe we can have a look at doing that, either RSI or moving average, when I pop into MT4 in a second. Stop loss orders can be placed at the recent low of the pattern. Okay, so that's around here. And take profit orders can be identified using key resistance levels. Okay, so let's have a look in MT4 for a piercing line. Let's have a look at Australian dollar, US dollar, and see where we can find a piercing line and see if it has been used recently for traders to make some money. So let's have a look. This is a very obvious piercing line pattern right here. What I'm looking at here is an obvious piercing line. Okay, so we have our downtrend. Okay, it's price action is just to the downside. We've got our bearish candle followed by the bullish candle. There's a slight gap down on the open of the bullish candle. It's closed way above the 50% level of the body of the bearish candle. So very, very strong confirmation. Again, secondary confirmation is given here with relative strength index, value of 36. So the downtrend has been very strong. Relative strength index reached 28 at this stage. It continued on down momentum and volatility and volumes, kind of petering out a little bit, the downtrend obviously losing momentum, and then we have our pattern here, our piercing line pattern, bouncing off Bollinger Band with relative strength index also confirming a bullish signal to start buying, and you can quite plainly see very clearly that traders bought at this level, probably, maybe even a little bit sooner, maybe even they bought here, for instance. As long as we've got this sort of close above the 50% level of the bearish candle, and in this case it's much higher, so a much stronger buy signal. So there we go. That's a very effective way for us to use the piercing line. In cases of moving averages, we can see that it's a good indicator that the bullish candle has broken through this 14-day moving average, and this again is almost like a third confirmation signal for traders to buy and enter the market and hold here. So as mentioned a moment ago, it would be a good idea to put stop loss levels around here, so that if this is, because there's no guarantees, as I've already said, with candlestick formations and candlestick patterns, they are indications. It's a form of technical analysis that gives you a signal. It is not guaranteed. But let's say, for instance, it didn't work out and we didn't have this uptrend after the piercing line occurred. So you would put a stop loss here, and let's say a news event occurs, or Donald Trump makes a tweet, or we have some bad data on the economic calendar, for instance, for the Australian dollar, okay? And the prices would then, the dollar would strengthen against the Aussie, and you would have a stop loss here, and your trade would be stopped out there, and you're not going to lose more money. So in the case of take profit orders, we want to look at key resistance levels, okay? So, I mean, key resistance level would be around here. All right, so it did go a lot higher, so you could have made a lot more money, but risk management is extremely important. It's important not to be greedy in Forex. If you've spotted a pattern like this with all these confirmations, then when you see it reach a resistance level, very key resistance level, according to this range here, support, resistance, support, resistance, support, resistance, take out your profits here, okay? So that would be advisable in this scenario. Let's move on to our next pattern, which is called the Morning Star. Now, the Morning Star pattern is a 3-candle bullish reversal pattern that appears at the bottom of a downtrend. All of these bullish patterns that we're going through tonight, they all appear at the bottom of a downtrend, because the idea, obviously, is looking for bullish signals you're looking to buy. All right, so you want an asset to be oversold, you want this downtrend, you want to identify it, and that's the case for all of the patterns we're going through tonight. Okay, so let me just go through exactly how to identify the Morning Star. It indicates the slowing down of bearish momentum in the markets before a very big bullish move lays the way or paves the way for a new bullish trend. It also is called, and it's also known as, the Morning Star Doji. It's worth mentioning at this stage that there are 5 different types of doji candles, which I could cover in another webinar. They're very interesting candlesticks. Now, in this particular formation, the Morning Star, we do have a doji candle, which is the third point here, a small bullish bearish candle. Okay, it could be a doji candle, a simple doji. All right, what dojis do, they tend to show indecision on the markets, but they don't all show. There's 5 different types, as I just said. They don't all show slowing, momentum, or indecision in the markets. Okay, so bear that in mind as well. So to identify the morning star, we firstly have to confirm an existing downtrend. Okay, so you should be seeing lower highs and lower lows, which is what we can see here. Okay, so here's the high of this candle, and that's a lower high and another lower high. Okay, so that's and we have, here's the low of this candlestick. It's lower low here and another lower low. So this is confirmation of downtrend, and that's what you want to identify firstly. Secondly, we need to identify a large bearish candle, a very large sort of drop, okay, at the end of this downtrend. The large bearish candle in this case is the result of very strong selling pressure and a continuation of the existing downtrend. So at this point, traders should only really be looking at short trades, sell trades, as there is no evidence of any reversal in the trend yet. Thirdly, a small or bullish, bearish candle. It doesn't really matter if it's a bullish or bearish candle. This third sort of confirmation or third identifier of the morning star pattern. It could be either or, okay, but what it is indicating is that it's the first sign of a fading downtrend. So as I said, it doesn't really matter if it's bearish or bullish. It could be red or green or whatever color you like to use for bullish, bearish candlesticks. But the point is that it shows a little bit of indecision. The market is undecided. What follows is a large bullish candle. Okay, so a large bullish candle should be forming after this indecisive doji candle or bullish bearish candle. So that's the next identifier or next thing we look for in the morning star, and it's the first sign that a bullish trend is beginning. All right. So lastly, for the morning star to be identified correctly is subsequent price action after this large bullish candle. And what I mean by that, subsequent bullish price action, so more bullish candlesticks forming. Okay, so ideally 3 or 4 bullish candlesticks forming, and this will confirm the identification of the morning star pattern has formed. All right, how do we trade the morning star? Once it's completed, the formation is identified correctly. It's there. We can see it. Traders look to enter at the opening of the next candle after the third large bullish candle. Okay, so what I mean by that is generally here. This is the pattern of the morning star. We need these identifiers for a morning star to be spotted. Okay, so traders will look at entering here and start buying here because that's what the pattern, and that's where the signal is giving you the buy signal. Okay, so conservative traders, more risk off traders, let's say, often delay their entry point and wait to see if the price action moves higher. There's a drawback to this, that and that is the trader executes the trade at a much worse level or a higher level, minimizing his or her profit potential. So your targets should be placed at previous levels of resistance or previous areas of support. Stop losses could be placed at below the recent support level, and we'll look for that in MT4. And the reason for this is that a break of that level would indicate a continuation of this downtrend. Okay, so if we had the formation and you put your stop loss somewhere here, then price action continues downwards and breaks your stop loss, it indicates that the morning star has not been a successful, beginning of a new bullish trend, and it's more likely that it's a continuation of this existing downtrend. As I've said, there's no guarantees in Forex and the financial market. So please, you should always use solid risk management techniques while maintaining realistic risk to reward ratios. So I will try to demonstrate that now in MT4. Let's pop in to MT4 and have a look if we can find a morning star pattern. Let's try Euro Kiwi again. Let's see if I think we've spotted one. It's quite obvious, actually, very obvious. Okay, great. So here's what appears to be a morning star formation. Okay, we have our downtrend, an existing downtrend. We have a large, quite a large bearish candlestick here. Then we have a small, very small bullish, in this case, a candle that's formed. And then we've got a large, it's not perfect, it's not a perfect morning star, but we do have a very large bullish candlestick here. And then subsequent bullish price action. And as you can see, if you had entered a buy trade at this point, relative strength index has also confirmed that the downtrend is oversold, that the Euro Kiwi or Euro New Zealand dollar, that's what this chart is showing here, is very oversold. Relative strength index is at a level or a value of 23, as you can see here. So relative strength index is confirming the morning star. This asset's oversold. The downtrend is oversold, and traders will be looking to come in and buy. And the morning star formation has worked perfectly in this scenario. And if you had entered after 1, 2, 3, the subsequent bullish price action, you would have made a nice little profit on this trade. Okay, and again, support levels would be placed here. Okay, this is where you'd put a stop loss, and we'll go with a take profit order. Key resistance levels at this. Now you have to imagine, obviously, all of this price action would not have been formed yet. Okay, we're only at this stage where we've entered our trade. So a key resistance level would probably be either here or even here, even higher. Okay, so we have resistance levels here. We have a resistance level here to put take profit orders. So you could have made some very, very nice, tidy little profits off this morning star formation. Okay, so this is how we would place stop losses and take profit orders if we were to buy after the morning star formation has formed. Okay, moving on. To the last pattern in the webinar tonight, which is what we call the 3 white soldiers. All right. Again, bullish candlestick formation. It's used to signal the reversal of a downtrend. The soldiers, or 3 white soldiers, are considered a very reliable reversal pattern when confirmed with technical indicators like relative strength index. The pattern suggests a very strong change in price action of an asset. When a candle is closing with small or no wicks, it implies that bulls have taken control of the market. So again, I reiterate that all of the patterns we're looking at tonight are buy signals. Okay. So how do we correctly identify the 3 white soldiers? So we've got 3 consecutive long-bodied candles that open at or within. Okay, so here's our first bullish candle, second, third bullish candle. So first soldier, second soldier, third soldier. Okay, so we've got our first soldier here. This is the close. The second soldier is opening at or around or within the body of the first soldier. And likewise, the third soldier is opening at or around or within the body of the second soldier. So this is what you're looking for with 3 white soldiers. They shouldn't really have very long wicks, but it's not the most important thing about the 3 white soldiers formation in my personal opinion. The most important thing about the 3 white soldiers for me when I'm identifying it and using it to buy an asset is literally just the consecutive upward trend and the fact that each candle consecutively opens at, around, or within the body of the previous candle, and they're all bullish. Okay, so it's giving you a very strong buy signal. All right, but it can be used in 2 ways. So as the 3 white soldiers is a bullish signal, it is used as an entry or exit point. It can be used, I should say, as an entry or exit point. Investors who are short or selling an asset anticipate closing their trades or their sell trades when they spot the 3 white soldiers. And investors who are waiting to take up bullish positions and start buying see the formation as an entry point. Okay, so short sellers see it as an exit point, and bullish buyers are seeing it as an entry point. Okay, it's important to note that the strong moves higher could create overbought conditions. So that would be identified with RSI or relative strength index, for example. It could be above 70, and there will be a short period of bearish downside following the pattern. But generally, the short to medium price action or short to medium term price action remains bullish generally. The significant move higher could also reach strong resistance levels, so you got to watch out for that. It would mean the asset could experience consolidation before continuing its move to the upside. So let's have a look and see how we can trade the 3 white soldiers. Essentially, you're looking to let's have a look and see, and we can show you exactly how to identify and how to trade it. All right, let's try cable or GBP USD again on a daily time frame. Bollinger Bands, moving average, relative strength index. Let's have a look. Well, we do have 3 consecutive bullish candles here. There is, there are also 3 consecutive bullish candles here. Okay, but this I wouldn't consider an extremely strong buy signal. We do have it at the bottom of a short, a very short sort of downtrend, but relative strength index is pretty, it's right in bang smack in the middle between 30 and 70. Again, 30 shows oversold positions, an oversold asset, and 70 shows on relative strength index that an asset's overbought and people are going to start selling, quite clearly demonstrated here, as you can see. So we've got a long downtrend. Over the very long term, we have a downtrend, and then we get here a strong downtrend, and then we have relative strength index much closer to 30. Okay, and also the first white soldier has it's at the bottom of the downtrend. It's at a support level, okay? So we've reached this low before where people have bought into the market, okay? So it's at support, all right? And it's also sort of hovering, it's below the moving average, which is another good indication that it's should be reversing back to the moving average, the median average and the median price. Okay, and again, relative strength index again confirms this. So we've got our first soldier here. The second soldier is opening at or around or within the body of the first white soldier. And again, the third soldier is opening within the body or just at around the close of the second soldier. And then, as I mentioned, you will find with this pattern that you can find some overbought conditions, and you'll find a short period of selling after you've identified 3 white soldiers. So where's the ideal place to enter the trade at this stage? Because as you can see, following the subsequent price action is very much to the upside after these 3 white soldiers, after this pattern has formed. So it's an idea. I mean, you can enter at the very top of the soldier, the third soldier. You can wait for the fourth candle and see where that where that sort of finishes. If it doesn't close below the close or the low of the third white soldier, it's also a good place to buy. So this could be your entry point here. Entry point could be here. Entry point could be here. All right. Let me just get the crosshair to demonstrate that a little bit more accurately. It could be there or it could be there. It's better here. Okay, it's better to wait for a bit of a down tick, as long as it doesn't break through this moving average. You're looking at a good buy. As you can see, it works very well, and you would have made a very nice profit from using 3 white soldiers in this case. Okay, so that's our last pattern. I mean, we can very quickly have a look at if we can find another example. Let's see if we can very quickly do that. 3 white soldiers, as I've said, it's very common. It's very commonly used with bull with sort of long bullish traders. Let's have a look. Okay, you could consider this again, 3 white soldiers. Again, RSI confirms it's below the Bollinger Band. It's way below moving average, 1, 2, 3, and it's just continued on. You've got a slight dip there, but again, bang, it's up to the upside, and way more to the upside here. So again, effectively, demonstrating that the 3 white soldiers works very well. Okay, so what I'd like to do is just very quickly go back into our presentation and just to discuss the effectiveness of all of these patterns and formations, and they depend, as I've mentioned over and over again throughout this webinar, that chart time frames, okay, are important. I like candlestick formations on daily chart time frames. A lot of traders short-term traders will use a 15-minute chart time frame, okay, but then they're looking to get in and out of the market much quicker. Okay, so more like scalping the markets, they're going to use 15 or even 5-minute chart time frames. So each candlestick represents 5 minutes. They're looking for, let's say, 3 white soldiers or whichever pattern we've mentioned, but they're looking to trade short term. I'm a position trader. I prefer longer time frames, okay, and I find that the candlestick formations and patterns are much more effective over longer time periods. Okay, so in other words, for more effectiveness, in my opinion, and just use longer time frames to spot the patterns. Make sure you're spotting the pattern correctly within the existing downtrend. Okay, if you're looking at bullish patterns, candlestick patterns, you need to be identifying the pattern at the bottom of a downtrend. Okay, if you're looking to buy, you want to be spotting it at the bottom of the downtrend. And that's extremely important. I mean, take the inverted hammer, for instance. You could spot an inverted hammer anywhere on a chart. And it won't work for you as a buy signal if you're spotting an inverted hammer at the top of an uptrend, for instance. It has to be the bottom of a downtrend if you're looking for buy signals. Additional confirmation using technical indicators, relative strength index, moving averages, Fibonacci's, commodity channel index. There are many technical indicators one can use to get additional confirmation with candlestick formations. Okay, always watch out for fundamental events. When I start my daily trading day, first port of call for me is to switch on Bloomberg, read CNBC, Yahoo Finance, etc., etc. I look at economic calendars and make sure I know exactly what time very important data points are coming out. Let's say non-farm payrolls, PMIs, CPIs. So do keep a a very close eye on fundamentals as well, because your technical analysis completely can be thrown out of the window and invalidated by big fundamental data or events or news headlines, etc., etc. And always consider the risk management. Okay, always think, where am I going to put my stop loss, where am I going to enter, how much do I want to make off this trade, and what is my risk to reward ratio. So let's say you would put I'm going to trade or risk $100 on a trade, but I want to make 500. So then your risk to reward is 1 to 5, correct? So we're going to go into risk management in next week's webinar into a lot more detail. So I'm going to cover risk management in a lot more detail. So if anybody does have any questions at this stage, they can ask me. We're getting very close to the end. I think I've overrun my time a little bit, and but if anybody does have any questions, you can ask me now. Okay, so what I'm just going to do is I'd like to mention the best way to read candlestick patterns is to practice entering and exiting trades from the signals they give. If you don't feel ready to trade live on the markets, then you can develop and hone your skills in a totally risk-free environment by opening a demo account with Forex Cube, where you can trade on currencies, commodities, indices, even cryptos. They're a fantastic brokerage, which is why we partner with them. Lightning fast execution, no slippage, very tight spreads, ultra tight spreads. In fact, they're a true STP ECN broker. You have safety and insurance of funds with them, instant deposits and withdrawals. In fact, they've got some of the tightest spreads I've ever come across. Lowest commissions, highest swaps, which is very important for us at Swap Hunter, obviously. So they're one of the best brokers in the industry. That's why we partner with them. That's why we work alongside them. They provide a fantastic environment for us and our clientele, with very good customer support, and they'll assist you with anything you need. And obviously, if you want to get a demo account or get a live account open with them, use the link in the chat in the webinar. Okay. And in the description in the webinar. Now, I'd also like to mention learning more about what we do at Swap Hunter. Okay, now we've done a couple of videos on YouTube, which you can check out. And essentially what Swap Hunter, what we do at Swap Hunter and what Swap Hunter is, it's an MT4, MetaTrader 4 carry trading indicator package. So it's a piece of software, it's an indicator package that is used with MT4. It's extremely easy to use, very intuitive. You can see that, this is the case in our tutorial videos on YouTube and on our website, which obviously you can see here, swaphunter.com. And please do visit the website. It's an extremely unique piece of software, the first of its kind. You can use it to protect equity, generate daily interest in your trades. No need to spend years learning about carry trading or learning about what swap trading is, or making calculations in regards to net swap differentials. It identifies and precisely calculates the strength of correlations between asset pairs in order to hedge and earn interest on your market positions. So by having the Swap Hunter indicator package in your trading toolbox, you are giving yourself an edge over the market. So that just about covers it for today. So thank you very much for listening and taking part in today's webinar. Once again, I am Christopher Smilas, Head of Sales and Trading at swaphunter.com. And just go to www.swap-hunter.com in order to get in touch and to find out more about our fantastic trading tools and services. So thanks once again, and good night and goodbye.